Hey everyone, it's Greg from Empire Flippers, and today I have a great story for you. So let me ask you a question. How would $12.4 million burning in your pocket change your life? For most people, pretty dramatically. And what if I told you you could do it in 9 months? What a claim. Well, this is a case study video of a Shopify store owner who is making around $274,000 in net profit every single month. They came to us to broker their deal, and we ended up selling that deal for $12.4 million in around 9 months. Now, 9 months is actually not that bad of a timeline for deals this size. As the M&A market has cooled off, we're seeing more and more deals take between 3 to sometimes 7 months to sell. And even before the M&A cool off, like a bigger deal that's in the 8 figures often can take 6 to 12 months, sometimes even longer, to get a deal closed. So we're pretty happy overall with the timeline. The seller is obviously very happy as well. And I thought it would be useful for you, for all my friends out there building e-commerce stores on Shopify or on some other platform, really any entrepreneur, to listen to the story, how we help this person get $12 million and more into their pocket. So let's talk about some of the quick facts of this business. Like, what was it doing? What made it so special? So the first off is the niche. The niche was in the jewelry space, specifically in a spiritual sub-niche of the jewelry space. So that's where it played. But one of the things that it did that was quite interesting was it was able to do subscription boxes. Now, subscription boxes are basically where a customer comes in and they say, yes, I want this, deliver this to me every single month, blah, blah, blah. And you as the e-commerce store owner do it. And this can be a fantastic way to basically create some monthly recurring revenue. Now, when it comes to e-commerce stores, it can be pretty tough to pull this off, if I'm being honest. Like, I've seen a lot of subscription box businesses in the e-commerce space, and to be honest, the churn is pretty bad on a lot of them. So the fact that this entrepreneur was able to pull it off is fantastic. If you are a Shopify store owner, if there's something you can do where you can package it up as a monthly subscription box for your customers to delight in, then go for it. You should absolutely do it. But if you're in a lot of the niches that really can't support it, then don't sweat it. There's other ways to get to this $12 million exit, which we'll get into here in a second. But for this business in particular, subscription box made up a significant chunk of its revenue. And by having that subscription box, not only do you have repeatable income, but it also really, really helps you to forecast what kind of inventory management you're going to need to do, because it's already clear who you're going to have to serve for next month's orders, right? Which allows you to have a much better inventory pipeline for your forecasting. Next thing that this Shopify store owner had true supply diversity. So I talk to a lot of e-commerce store owners all the time, and they'll say, oh, our factory supply line is diversified. We have 3 factories in China. Well, during COVID, when the Shanghai ports got shut down rather, we found out that's not really diversified at all, because I think it's like 90% of cargo containers ship out of China from the Shanghai port. So if something happens to that port, all the diversity of all those factories that you have in China are kind of worthless, right? Like, not saying you shouldn't be manufacturing in China, but you should also have a true diversified supply chain. So in the case of this seller, they had a few factories in China. They had one in India, they had one even in America, and I believe they had one in Mexico, although I might be misspeaking on that. But anyways, they had around 6 factories that were not just diversified within one country, but rather diversified all around the country, or across multiple countries, sorry. So this allowed true diversity and made the business, honestly, just a lot more anti-fragile to the whimsical ways of supply lines, right? Now, the most important part of this entire case study, if you take one thing away from it, then listen to what Greg is about to say. One of the things that this business had going for it, that most businesses that I come across don't, is that it's growing. So most entrepreneurs make the mistake where, like, I am going to squeeze more juice out of this stone or this fruit, whatever the saying is, and I'm going to sell it once I'm done squeezing all the juice out, once I've optimized it to all I can. Now that sounds great in theory, like that you should do that you should get a bigger valuation that way, but it doesn't actually work out in practice usually. In practice, what you want to do is grow the business to a certain point where you feel like, I don't know how to take it further, but before you get to that point where you get to that peak, you want to be selling as you're going up the peak, which is called the S-curve. You want to sell there, and that's what this business is doing. It wasn't declining. Now I mentioned that most businesses I see are stagnating or declining by the time they come to me, because what ends up happening is the entrepreneur is like, well, I've taken it as far as I can do. Let's see what Greg and EF can do over there. But they're giving us a stinker. Like, it's not easy for us to sell that business because buyers don't want to buy a declining business, or at least they're definitely not going to pay you a premium price for the opportunity to risk all their money on buying your declining business. It doesn't make sense. You want to do it, it's unlikely they're going to do it, right? Now, there are definitely buyers out there that buy declining businesses. We sell them all the time, but they are rare and they're going to give you a worse deal. And there are buyers who will buy you at the peak, but again, it's not their favorite, so you're not going to get the best multiple. But if instead you have a business that is growing, that means they have a sense of urgency, like they better buy now because the price is going to go up, and they're willing to overpay a little bit, pay you a premium to be able to absorb the growth that the company is going through. So this is all very, very important. In fact, this is the most important thing in my view. You should sell your business when it's growing ideally. Not saying you can't sell it any other way. It's just you're going to have a worse time if you try to sell a business that isn't growing. All right, let me get off my soapbox and we'll move on. So the next thing that this business had, it had 230,000 email subscribers and roughly over 500,000 social media followers across its platform. This is fantastic. Now, social media social media followers, that can be fake. There's all sorts of screwy stuff you can do. And even if it's not, even if it's genuine, it is a soft asset. Like, it is an asset, but it's an asset that lives on someone else's platform. So it's not exactly like something you really truly control. You can't do much with that follower account. And Instagram and Facebook or wherever your followers are can always take that stuff away from you, right? But the fact that you still have it and it's showing engagement, all good signs. What's really valuable here is that 230,000 email subscribers. So like the beautiful thing about e-commerce, in my opinion at least, is how much control you have. You control the marketing funnel, you control the sales funnel, you can do upsells, downsells, cross-sells, order bumps, all sorts of stuff. And if you're building an active email list where people are actually opening up what you're sending to them, that offers you so much revenue expansion ideas. Like, you want to launch a new product? Why don't you email your list that loves your brand? Hey, what would you like me to sell you next? I have friends that actually do that with their email list, and it's one of the best ways to do R&D. You could even put up kind of like your own private Kickstarter with an email list like this to jumpstart the funding of your next product. Like, hey guys, you said you all wanted X. Here's the pre-order page for X. Like, if I reach this amount, then we are ordering it, and you guys are going to get like a slick discount for being the first customers, right? And this is a way you can bankroll the actual inventory costs and the supply chain costs of getting that product to your customers' hands before you even spend any of your money. So anyways, again, off of my soapbox, but email list to me is one of the best assets of any business you can buy, in my view. So who did they sell to? Well, like I mentioned, this business was making roughly $270,000 net profit per month. It was showing 70% year-over-year growth, which is titanic growth. You don't need to match that kind of growth, but if you can, all the better. And this kind of money at this kind of level, they got bought by what I call a financial wizard. So usually a financial wizard is going to be private equity backed, or maybe they are the private equity company. In this case though, it was a little bit different because the financial wizard wasn't necessarily a PE backed company. Instead, they were strategic. So with strategics, there's basically two levels. There is the normal entrepreneur who maybe is a little bit further ahead, like you, further ahead than you with the business that you're selling. Or there's the more financial wizard strategic partner, which this is definitely more in that realm, where they have the same kind of capital pools and resources as the private equity companies out there shopping deals for their funds. So in this case, the strategic partner was someone who was already operating in the fashion and jewelry space and was a multinational public company. So if you ever wonder what kind of buyers does Empire Flippers have on our marketplace, well, we even have public companies that are multinational shopping on our marketplace. That's the level of the distribution that we have. So that's pretty cool. I just thought I'd point that out. So let's talk a bit about this buyer. So what I like to call the strategic comes a knockin'. So when it comes to selling your business, a strategic buyer is almost always hands down the best kind of buyer you're gonna get. Because especially if they're on the financial wizard level, because they can spend more money than the financial wizard. In most situations, the financial wizard, that's just the PE guy, can spend the most money because they have the most resources, but a strategic can actually overspend the financial wizard because by buying your business, if they're a strategic, increases the synergies of all the other things they got going on by so much, where they are fine paying that premium. And unlike the private equity person, who they are often bound by the mandate of an investment fund that will last anywhere between 5 to 10 years on average, where they need to flip everything in that fund to return their investor capital, a strategic often has a much longer time horizon where they don't have to do that. Like, they might buy your business, pay you at a premium, and they don't really care about making a profit with it for like 2 to 3 or 4 years, much less flipping it in less than 7 years, right? So because of this longer timeline horizon, the better synergies that line up, the strategic can just honestly beat the financial wizard in almost every way. And the nice thing for you is usually it's a lot nicer working with a strategic that wants to buy you, because they inherently understand the value of what you are building. So in this case, the strategic buyer, like I mentioned, was a multinational public company, and they're already operating in an adjacently similar niche. So what this means, when they could take over this company, they get all these economies of scale already built in. One, they get access to a brand new audience to expose that audience to all the other products in their portfolio, which if they like this product, then they will probably like this product kind of thing. It's a cross-selling between brands. The other thing that they get to do is, because of their supplier relationships, they can probably cut new deals with the seller's old suppliers or switch up the suppliers to their suppliers. And through economies of scale, they're able to get their order costs and the actual logistics costs of shipping those products way down, because they can probably buy entire containers rather than partial containers. They can do way better inventory forecasting, and they can cut a deal with a supplier like, hey, I will order in this amount of bulk, you give me this amount of a discount. And the truism in e-commerce, the more you can spend, the bigger discount you're gonna get. So that's the economies of scale portion here that just works fantastic with this business. All right, so let's talk about the actual offer here. What did the buyer do that made the seller happy? Well, didn't do it at first. So when you're selling a business, it is very common that the opening salvo from the buyer, the very first offer, is them testing the waters. And I feel like that is probably what happened here with this buyer in particular. So when they put in an offer for this deal, they offer $11.9 million at a 45x monthly multiple. And remember, the business was originally listed on a marketplace for $13.6 million at a 49x multiple. So they're coming down on both sides here, right? And the buyer said, we will give you 50% of cash upfront, and we will pay out the another 50% over a 2-year period through seller promissory notes over equal portions across those 2 years. Now, the buyer also wanted something that's pretty reasonable. The buyer wanted the seller to spend about 3 to 6 hours per week to help the buyer transfer the business fully over. And that's pretty common, especially like a bigger deal like this. I'm honestly surprised they asked for so little on that front. So what did the seller say to all of this, right? Pretty good deal. Well, not to the seller. The seller rejected it. So as you do, there is a saying in M&A that a deal dies 3 times before it gets done. And usually the first death happens at the first offer, especially if the seller has not gotten another offer yet. Because they might be insulted, or they just think it's unrealistic, or they're waiting for something better, and then the something better never comes, and then they come crawling back to try to make the deal live again, which didn't happen in this case, but those are just examples. So if you're trying to sell a bigger business, expect to have road bumps where either you accidentally kill the deal, or the buyer accidentally kills the deal, or maybe even kills the deal on purpose. That's all part of the game. Don't let it get you down. All right, so the seller rejects the initial offer and gives a counter offer to the buyer. So what does the seller say? What does the seller want from the buyer? So the seller counters the offer saying, look, I will give you $12.9 million, or I want $12.9 million for my sales price. I will include my entire inventory in that sales price, which is about $1 million in of itself. If you didn't know, if you're buying an e-commerce store, brokers sometimes do these 2 different ways. Some brokers will put the inventory in your actual sales price, and some brokers like us put this actual inventory price outside of the valuation. Now, you as a seller, you need to be careful on this and know which way to go, because if a broker is putting your inventory into the actual sales price, so that $1 million, then that will also count towards their eventual brokerage commission, right? So you want to be careful on that front. There's no right or wrong way to do it, but we tend to put the inventory outside of the actual sales price. So in this case, the seller came back like, hey, look, you gave me this $11 million deal. How about $12.9 million? I'll throw in $1 million through the inventory, so you don't have to spend any extra on the inventory. And I want you to pay me 75% of the price upfront. we can do, 80% of the payment up front. So that was the counter offer that the seller put. So again, 12.9 million, 80% payment up front. The buyer, of course, rejected this, which always happens, right? You're trying to meet in the middle. So there's always going to be this back and forth. And it's very, very nice, like very collaborative. There's no like, I got you or anything like that. They're both trying to figure out how can we work together to match each other's goals, because right now we're a little bit far apart. So the buyer realizes where the seller is at, like, okay, well, I think I can do something that would appease you and also make sense for me, because the buyer, remember, they're paying $12 million to inherit the risk of everything going to crap, right? So they need to protect their own downside a little bit in some shape or some form. So what the buyer ends up doing is says, look, I agree, $12.9 million sales price with inventory included. That sounds great, but instead of paying you 80% up front, how about we do 75% up front? That's only 5% less than what you're asking for. So it's pretty close to the cash up front of what you want. And then we'll take that 25% that we owe you for the remainder and we'll break it into two different structures. So what the buyer ends up doing is they put 15% in what is known as a holdback period to be paid in equal amounts every 6 months over a 2-year period. So they still get their 2-year holdback period that they wanted initially, and the seller gets pretty close to the cash up front of what they wanted. Now the buyer also says the remaining 10% of that, instead of it being just in a pure seller finance holdback, we're going to do that as a performance earnout. So you will be paid that remaining 10% in equal quarterly payments over the course of 1 year, as long as it's contingent on a 10% growth in revenue and sales. So this 10% growth in revenue and sales, usually earnouts are going to be tied to some kind of revenue growth. I honestly think, based on the year-over-year growth of this business in particular, 10% growth rate as a hurdle is not terribly unreasonable. And that gives the buyer some protection. Like if something goes wrong with that business over the year, at least there's 10% of their capital that won't be lost in the exchange. And this gets the seller very close to where they initially wanted. So what does the seller do? They accept it, of course, and they become a multi-millionaire overnight. Now, of course, it was a long night. They spent years building the e-commerce store, right? And then they spent the better part of a year actually selling it in what is honestly a very hard market right now to sell in, because of the how strict right now capital is overall. But still, this is a fantastic outcome, and it's an outcome that you can get too for your Shopify store if you build your store correctly. So a few things to take away from this business. Like if you watch a lot of buying business content, you probably come across all sorts of gurus out there saying, no money down, 100% seller finance, blah, 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 all these like tricks of the trade that you can do where you're spending very little capital when it comes to buying a business. Now, whether you're a seller or a buyer, what I'm about to say holds true regardless. Like all those strategies that you hear that get popularized on social media, all of it's true. You can 100% do it. I have a buddy, or not buddy, but a person I know that has acquired 14 marketing agencies, or pretty significant marketing agencies, with $0 out of pocket. But the thing is that those gurus never tell you is those strategies are, one, very uncommon, and two, very hard to pull off. They're extremely advanced strategies. Now, here we have a public multinational company not doing any of those shenanigans. They're giving you the money. And it's a very clean structure. Like it's not extremely complicated. Like you look at the deal, the asset purchase agreement that they ended up doing, it is very clean. It's nothing crazy. There's no like hidden gotchas. It is a very straightforward deal. Here's the upfront amount. Here's what we're going to do in seller finance. And here's what we're going to do in a performance earnout. Very, very clear, not complicated whatsoever. None of this like insane like factoring or loans, et cetera, et cetera. It's a very simple deal. And I bring that up to show you like this is how you get big deals done, like or even smaller deals. Like if you're a buyer, cash is always king. And if you're the seller, you should strive to try to get your upfront amount. So in this case, there's 80% what the seller was willing or wanting to walk away with. Now they came down a little bit. They went to 75%. And this is another important lesson if you're a seller. Like a lot of sellers, like I've mentioned in other videos, they way overblow their own valuation, or they're so rigid that they just like, or they walk away from deals that are like really, really good for them potentially, right? So you want to have your goal in mind, what you want to walk away with, but you don't want to be like a rigid tree in a hurricane that gets blown over with the strength of the wind. You want to be able to bend with that wind a little bit, be able to compromise a little bit. And in this case, it worked out fantastic. I mean, this seller, just got over $12 million. That's amazing. For a bootstrap business, like if you look at Silicon Valley style exits, when that entrepreneur goes and exits their business for, tens of millions of dollars, and most of the time, if they were VC backed, which a lot of the Silicon Valley tech companies are, that entrepreneur gets almost nothing. Like very little of that pie is the entrepreneurs. In this case, this was a completely bootstrapped e-commerce store that started, I believe, in 2018. So not even that long ago. And this founder gets to keep the vast majority of that wealth. And that is life-changing wealth. So if you want life-changing wealth as a Shopify store owner and you want to figure out what you are worth, click the valuation tool link in the description down below, or just go to empireflippers.com valuation-tool. I've been Greg, you've been great, and I will see you on the next video.